multifamily tonight. All righty. Kicking it off. I first want to say thank you to everyone for joining us for the event. Can we try it up a little bit? Every second, every second Tuesday of the evening, of the month, we do this event in Austin. We bring out guest speakers, experts in their field to come and teach about different private investment strategies, assets, to give you guys a little bit of a better understanding and some more education. Work with people. So I'll go ahead and get started. Just like this class, we have a lot of educational material for you guys. Resources in the way of blogs, in the way of videos, events. You can always go back and live stream them as well. So every Saturday at noon, we have what we call our Self-Directed IRA Saturday webinar. That's going to be 100% online. It's cutting out, isn't it? Well, let's see if maybe we can get another microphone up here, if that would be okay with you. We are cutting out a little bit.
Want to try this one?
Okay. And I'll just give it right back to you.
Perfect.
Can you guys hear me? All right. Okay, I'm just going to hold this because that's easier. Alrighty, so like I was letting you guys know, we have a lot of educational classes, whether it's the Self-Directed IRA Saturday webinar every Saturday at noon Central, or the Self-Directed IRA Social, like I was saying, every second Tuesday of the month here in Austin. Or if you want to venture over to our Houston office or our Dallas offices, we do them as well. Houston's going to be the first Tuesday, Dallas is the third Tuesday. We're right smack dab in the middle. But we also do lunch and learns as well. Now, I will let you know we are going to be getting rid of our lunch and learns starting in July. So if you do want to come to a lunch and learn, be sure to do that for May and for June. We will be bringing you a new exciting event in its place, so stay tuned for that. We will not be doing the National Networking Happy Hour, but I left it on here just to remind you guys that all of the webinars that we have and the classes like today, they are live streamed, and you can network with people in that chat box. We've had people post their deals, post what they're looking for, and get connections that way as well. So our promo for the month, and I want to put this slide here because it's about to end, at least this side is. So right now we're doing our rewards for deposits promo. That pretty much means if you are ready to move in money, maybe you have a deal, we're going to give you money for moving money. So if you move over, maybe do a rollover, do a transfer, make a contribution to your account, we will provide you with a credit as well. Maybe that's going to go towards a transaction fee, maybe some billing fees, but we've got this little tiered system over here. Or up until the tax filing deadline, if you want to open an account, you can do that totally free. Normally it's $100 to set up an account, but every April we do our special promo. We are completely waiving the fee to open a new account if you'd like to take advantage of that. The little coupon codes are right here. I don't know if I've got a pointer. Okay, there we go. So here are the coupon codes if you want to take advantage of that, or if you want to talk to me in the back, maybe have a consultation, happy to do that as well. As always, we have our referral program. If you want to send somebody to Quest and you have an account as well, even if you don't, we're going to give you a credit and them a credit as well for getting started here at Quest. This slide is the most exciting one. How many of y'all have been to the Quest Expo? Oh my goodness. Well, that means everybody needs to come in 2024. No, the last expo that we did, we had, I think, 750 check-ins was the last we checked. It is the biggest event that we put on. We're doing it at the Irving Convention Center. We're expecting about 1,000 people to be at this one. So we will be doing it. We have already got the location set. It's going to be June 28th and 29th with a little happy hour before. So save the date. That is coming, and we'll be bringing more information for it soon. But I'm so excited because, like I said, that is just the biggest and the best event that we do every year. My last slide, if you do have any more questions about getting started, any of those promos, any of the events that I talked about, maybe you have some education and you want to come up here and teach, I would love to talk to you. You can either call me, talk to you on the live chat, send us an email, or if you want to schedule a consultation with any one of the IRA specialists like myself or the other ones on our team, you can scan this QR code and it'll take you directly to the Calendly link. So without further ado, minute over, that's all right. I'm going to go ahead and bring up our speaker for tonight, who's going to be talking about making moves from surviving to thriving with commercial real estate investing. So let's give a big round of applause to Devin Elder. Give this back to you.
Perfect. Yeah, that worked out good. Awesome. Thank you so much, Sarah. I'm going to get my mic set up here. How's that out there? Can you guys hear that okay? That's all right. Hey, good evening, guys. Thanks for coming out. Appreciate it. And hello to everybody visiting us online. I'm going to kind of get situated here. And y'all can see the screen? Good? Yeah. My name's Devin Elder. We come up to Quest, up from San Antonio, and talk about real estate investing. So I'm going to go through this presentation that we prepared for you guys tonight and talk about some of the things our firm has done over the last couple of years to go from surviving to thriving, right? That's the title of the presentation here, but we've done some very specific things in order for that to happen, and we've been very intentional about it. And so I want to share that with you. And then one of my favorite things is just to network and talk about real estate, talk shop. I had some mentors early in my real estate investing career that really put some light bulbs off for me and set my life off in a whole new direction. So I like answering questions. I love doing Q&A. So I'm going to save a lot of that for the end. So you got questions, write them down or make a mental note. We'll do them all at the end. So we're going to get into the presentation here. The presentation at a high level, we're going to talk about our firm, which is DJE in San Antonio, Texas, right down the road, right down 35. We're going to talk about surviving, thriving, sustaining that success, and then as I alluded to there, some Q&A. Throughout the presentation are a bunch of photos, and these are photos of our assets in San Antonio, Central Texas, and I'm going to talk a lot about those assets, what kind of asset classes we're in, how we operate it, investment thesis, all that kind of fun stuff. We can talk about this stuff for hours, but I think I'm only going to go for probably 30 minutes or so tonight. So that will be tonight's presentation. A little bit about me. I'm an entrepreneur, real estate investor, educator. I host a podcast called the DJE Podcast. It's a weekly podcast that you can go get. I was just talking to somebody in this room that's trying to kind of get networked and educated. I like podcasts for doing that. It's free. You could kill some windshield time. My last corporate job I had in corporate America, I left in 2015. And for 2 years before I left my job, I must listen to thousands of hours of podcasts. I would go to lunch. I'd actually go to lunch not with my coworkers because they would just complain about work and not do anything to change it. I'd go just chow down, listen to podcasts, and downloaded thousands of hours of knowledge from other entrepreneurs. So now I host that, and I think it's an awesome way to be a fly on the wall. And obviously you guys know what podcasts are, and there's an endless amount to consume, including ours. So we publish weekly and have some great guests that are in the same spaces that we are. I don't know how much of a bio there is. I'm from San Antonio, Texas. I've been married for 15 years. I have 3 kids. Actually, kids' names are the name of the company. So DJE is Dylan, Jacob, and Emily, my 3 children. My initials are DE, so everybody thinks I named the company after myself, which is fine. I've even signed loan documents on $20 million deals that say Devin J. Elder, which is not my name. But people assume these things, and that's okay. So I graduated from UTSA in San Antonio, and I spent a decade in the corporate world doing sales, marketing, things like that before striking out on my own and starting this company. So that's just a little bit about me. This is kind of a snapshot of some of our corporate team. Justin, top left there, is over here. How about a round of applause for Justin over there? Came all the way out. He's our head of investor relations. And Destiny Lopez, the one and only, came all the way up from San Antonio, Texas to hang out with you guys. So be sure to visit them, pepper them with questions, take a koozie, get to know them. Great team. And then some of the other team members up here, some on our leadership team, some of our folks on the property management side. We're actually at about 85 employees right now, so a lot more than this slide, but we kind of like to have a slide that shows some of the faces. It always, when I see a website and there's all these stock photos of people like, we're doing business. I'm like, it's either stole that stock photo or paid $5 for it. This is like actually our people that we work with every day. I think it's important to put a face to that. So that's why we kind of showcase that on the website. So about our firm, we're a vertically integrated real estate investment firm and property management company based in San Antonio. Started a decade ago. Pretty wild. Time flies. So we started out with a single deal, a house on the south side of San Antonio. I bought for $40,000. Was super scared about it. Had a $10,000 rehab. Some of you guys might be into flipping houses. Anybody flipped houses or done rentals in here? All right. Yeah, so y'all know the drill. So I did a little burr house that joined a group, paid a bunch of money. They taught me how to do that. It worked, and I did a bunch more of those, and then ended up doing 100 of those, and ended up doing apartments and growing from there. So that was kind of the trajectory of the company, and now fast forward to today, we've done over 5,000 units of multifamily, pretty wild, valued acquisitions over $360 million. Right now, as it stands, we manage about $250 million of real estate in Texas, which is mind-boggling, but it's been one foot in front of the other for the last 10 years to get there. So that is a little bit about our firm. And as I mentioned, all these photos, I don't know if you can see it as well on this. You can see it pretty good on the TV I'm looking at. These are all assets that we own. So this is an asset that we have in San Antonio off Babcock Road called The Ascent that we bought from a company out of Dallas a number of years ago. And so you'll see throughout the presentation some of our assets here. Portfolio, this is just kind of a snapshot of our portfolio. We do a lot of different things, and this is not the whole thing, but it just kind of shows you San Antonio multifamily is kind of our jam. So the Ascent I just mentioned, 154 units. North portfolio was a 600-unit portfolio we bought last year, so on and so forth. Travis Building downtown, actually on the Riverwalk, San Antonio. Pretty cool building that we're getting ready to lease up right now, and I'm pretty excited about that project. So we do a lot of multifamily. We also do land, industrial, and I'll dive into those in a little bit here. And part of my goal tonight is to just explain what we do. And sometimes, and part of what I do on the podcast is just kind of, for folks that have not been invested in a private placement or directly in a real estate project, sometimes it's totally foreign. Or maybe somebody's just trying to get up to speed on this business. So this is kind of a general presentation to a general audience. That's why I want you guys to write down your questions online if you have questions. I don't know if we're going to have an opportunity to address some of those, but write down your questions, and I'm going to have a general presentation about our firm, the things we do, and then we can do questions, but hopefully it sparks some interest or piques your interest to kind of follow up with some questions. I don't really have a specific agenda for this presentation other than just kind of talking about the things we've done and how we've done it and why we've done certain things. So a lot of multifamily, that's always been a part of the firm for most of our history, although I did start out doing single-family houses. Those, you could kind of run into a scaling issue. Seems like everybody wants 10 rentals, and they get to 10 rentals, and it gets a little unruly after that. And a lot of folks will go to multifamily after that, either as a LP, a passive investor, or as an operator. Surviving hard times. So March 2020 was tough, right? I think we'd all kind of known since 2008 that something was due, right? After the global financial crisis, that shook a lot of stuff up. The global financial crisis, 2008, actually shook me up a little bit when I was in corporate America and saw my retirement account kind of get cut in half, and it just made me think, gosh, I think I need to start developing some other streams of income, which actually led me to looking into entrepreneurship and eventually landing on real estate. So 2008 kind of shook it up for me, even though it would be a number of years before I actually started investing. But I think we'd all kind of known by 2020 that this cycle was a little long in the tooth, that something was coming. We didn't know if it was going to be another real estate crash or whatever. Turned out it was a pandemic out of left field that caught everybody unprepared, obviously. And I always use, people ask me what I think is going to happen next with the economy of the Fed. I kind of just point back to January of 2020 when I had some really good plans for that year and goals and what I thought was going to happen. And then March 2020 completely changed that. So I don't ever pretend to know what's around the corner. But surviving hard times, some of the things that we started doing immediately, because we owned a lot of these big assets, right? $20 million apartment buildings with lots of investors. One of the things we started doing immediately was focusing on communication, and a lot more communication than we normally do. So for our investments, we sent out a monthly update to our investors, and we started going to weekly or sometimes daily updates on what was happening because everything was changing so rapidly. Nobody knew if this was the end of the world or what was going to happen. So we decided we're just going to over-communicate until things kind of normalize here. And that proved to be very well received. We also stopped distributions on a lot of our projects because, again, we didn't know if the world was ending. We were sending distributions out monthly to all our investors, and we said, hey, these projects are performing well, but we don't know what's happening. We're going to pause distributions. It's going to still accrue. It's due to you, but we're going to pause it and hold on to cash because nobody knows what's going on. So that turned out to be a good move, although by the end of 2020, we caught up all the distributions and resumed distributions, but I think any business owner, that's a prudent move to retain cash when you're in that kind of an emergency situation or hard times. And it certainly changed the way we looked at deals and underwrote deals moving forward with maxing out our cash reserves as much as possible and things like that in our underwriting models. And then we focus on the experience. So we've always kind of believed that the best marketing we could do as a firm to bring on new investors is just the experience, because it's the best marketing for any business to have your neighbor tell you about it. They loved it, right? My neighbor tells me about a great new restaurant. Like, I don't care what their Facebook ad says. If my buddy tells me it's great, I'm going to go check it out. So we've always strived to be a firm where people will volunteer to refer somebody without us asking. I'm not going to ask for a referral, but if we can create the best experience for you where you're going to volunteer a referral, and that's exploded our business by focusing on that experience for our clients. In this case, is our investors, but also on the employee side. I was fortunate enough to work for a tech company in San Antonio that had a really emphasized focus on the culture of that company. And I thought I was a little hokey at the time, but I saw how powerful that was. It was incredibly powerful to have that, and the kind of the camaraderie and teamwork that resulted out of that always stuck with me. And so we've strived to kind of recreate that with a focus on our culture. So there's all kind of things that we do within our company to be intentional about creating a really solid culture. Because at the end of the day, if the pay and the benefits are the same, you're going to go where there's a better culture. So those are the things we focused on starting in 2020, was more frequent communication, holding on to cash reserves when things got really crazy, and then we could loosen that up later on, and then focusing on the experience for the client investor and for the employee as well. So some of the underwriting that I'll dive into: fixed versus bridge debt, rate caps and prepayments, loan to value and co-investment. So just to kind of get into the nitty gritty on the finance side of it here, maybe this will drive some questions here, but on the project specifically, our multifamily projects, you can go with floating rate debt, which means the rate will change based on what the debt market is doing, and fixed debt, meaning you can get a loan at 3.5% interest and it sticks there. So there's a lot of flexibility with your bridge debt and your floating rates. So we did definitely get into some of those, but we would always purchase a rate cap, meaning that if the rate floated up, it would be capped at some point that we could account for. So we've seen that on a couple of our projects where you've had the debt service go up a lot because you got a floating rate go from 3% to 5% on a $15 million loan. That's going to change things a lot. But it didn't go higher than 5% because we purchased a rate cap insurance policy. And I'm happy to answer any questions on this because this is getting a little wonky here to dive into the details. But it's important, I think, as an investor to understand some high-level points. If you're looking at a deal to invest in, I'm going to ask, what kind of loan is it? Is it fixed rate or floating? When does it mature? What is your exit cap rate assumption? And honestly, the details of your line items projected 5 years into the future, those are going to be wrong. But I want to know some big picture stuff. What's your leverage on the loan? If it's $10 million and you have an $8.5 million loan, that's pretty high leverage. If it's $10 million project and you have $6 million loan, 60% leverage, that feels good. So just looking at some of the ways that we could be more defensive about that, because in real estate, you don't want to be a forced seller. And if you can avoid being a forced seller, you're probably going to end up okay, because real estate over time, yes, it tends to go up. We know it has ups and downs, but it does tend to kind of correct or heal itself if you give it enough time. So understanding where a real estate operator is going to have a gun to their head in terms of a loan maturity or the rate skyrocketing is, I would say, probably one of the most important things. The entire real estate market is driven by the debt terms when we're talking about deals of this size. You're buying a house, flipping a house, cash, whatever, it's kind of not as important. Your buyer, the debt terms will be important to them. But you're buying a $10, $20, $30 million building, the debt terms absolutely dictate everything. The price it's going to trade at, whether or not it cash flows, and everything. So how we've changed in the last couple of years is just making sure we're not going to be in a position to be a forced seller, because that's when you lose money in real estate. Also looking at rate caps, those insurance policies that prevent our rate from going too high. Your loan to value and being conservative on that, making sure that the operator of the real estate is not taking your leverage too high. And then co-investment. I think it's important to always ask what is the sponsor's skin in the game? Or I heard a really good question if you're investing in a deal. And you gotta have some political delicateness about this, because if you're trying to put $100K in somebody's deal and they're raising $10 million, and you pepper them with 30 questions, and they're not going to want to work with you, just period. So you got to be polite and pleasant to work with, I think. I try to be that way if I'm a limited partner or an investor in somebody's deal. But it doesn't mean you don't ask any questions. But I think a good question for a sponsor is, if this deal loses everything, how much do you make? And the answer should be $0, or I lose money. The sponsor should lose money if you lose money, right? So there are fees and things like that and equity that the sponsor gets. It's why we do this, right? We do the hard work of going to run these deals. But co-investment is also super important. So a lot of times the lender will require a 10% co-investment. But that's something to think about. And so I think over the years, as our co-investment has gotten higher, I think it's given investors a higher comfort level to say, hey, we're doing this deal over here, and our principal's putting in $500,000. I've had investors say, oh man, well, that's way more than I'm going to put in. You have a lot more to lose than I do just from a cash perspective on this deal, not to mention the fact that this is our livelihood and our reputation on these deals. So co-investment is super important. It also means there's less money for investors to put in. So you want to look for a strong sponsor co-investment. The trick, I think, too, is a lot of sponsors that do deals for a number of years, they kind of get to their investor limit and then all right, that's it, we're not taking any new investors. So you want to find an experienced sponsor, but then also one that's still taking investors. So that's a balancing act for sure. Focusing on the client experience, hiring specialists. A real turning point for our company was a number of years ago when we started the property management company, because we had some bad experiences with some third-party management companies, which is, I think, just inherent. If you've got a company that manages 8,000 units, that's a big company. They've got accounting team, they've got regional managers, they've got dozens, maybe hundreds of employees spread across maybe numerous states, and you've got 150 units out of that 8,000. So, and I'll tell you, property management is hard and it doesn't make money, right? Not good profit margin in property management. The one thing that people might do with property management companies is roll them up, grow to 20,000 doors, and sell it to New York private equity. So when I see somebody aggressively building a multifamily property management company, I'm thinking they're usually doing a roll up to sell to private equity for a really high multiple, and that's fine if you want to play that game. I don't want to play that game. I don't want to hire a bunch of people and talk about culture and then sell a company to a private equity. So we started the management company to drive performance at our own deals. So that involved hiring specialists, and the control that gives us and the ability to execute quickly is it's the best. I absolutely love it. Even if the property management company doesn't really make a lot of profit, it is profitable, but not great margins. But the ability to walk down and talk to our director of accounting, or the ability to send somebody a quick message and get a report in minutes versus days, compound that across thousands of interactions in our company, and that leads to real results. Consistent communications and distributions. Back to the client experience here. We've always been a tech, forward firm, and having the investor experience go through a portal and have the ability to send monthly distributions on these projects consistently like clockwork is huge. And so rather than sending distributions annually or quarterly, we're sending them every month along with consistent communications. And honestly, this is where a lot of sponsors fall down. I'm a limited partner or a passive investor in a lot of deals, and there's inconsistent communications or no communications. And when that happens, you just got to wonder what else is wrong under the hood. We've found that by being extremely consistent with distributions and communications, people are saying, okay, this is all going pretty good. Seems like you guys are on top of it. And so that experience is super important for us. And leveraging that technology for growth has been amazing. Along with hiring, dedicated resources. I'm not wearing the hat of investor relations and this and that. Justin has joined the firm years ago and has built and grown that department to the point where, he owns that experience, and we've gotten a lot of feedback from our investors that is a huge differentiator for us. So that, again, not an accident. That's by design, focusing on that client experience. And the takeaway or the goal for us is to create such a great experience that you would voluntarily refer somebody to us without us asking, which to me is a pretty high bar. Focusing on the resident and employee experience. So we have kind of two companies, right? Private equity company that raises capital and deals with investors. And we have a property management company that manages the asset and our hundreds of residents across our properties. So being specialized on the property management side has been really helpful for us as well. And that's, there's all kind of things that go into that, whether it's personality testing on the front end in our hiring process, to the culture, to the training, and hiring specialists that can go in and execute at the property management level has been a huge differentiator for us. Okay, so some of the things we did to survive, and then moving over to thriving here, what have we done over the last, I'll call it 3 years, right? Because we're kind of up in that 3-year anniversary for COVID. Isn't that crazy? It's 3 years since March 2020 when COVID hit. Just wild. But what have we done to thrive during those years that have been hard times kind of for any business, really? Vertical integration is one, and that's building the management company. So we manage all our stuff. We're not relying on a third-party company. That has its own sets of challenges, but it has its own sets of rewards too. So that's been huge. People like hearing that. The lenders like hearing that. Investors like hearing that. And investing with those who care about culture and values. So we started the values for the company kind of day one and have built the company around that. And the same thing with the culture. We're very intentional about those things. And it's a little hard to connect those things, I think, directly to ROI sometimes, like as a business owner, but you can absolutely see it. And our COO and I talk that, you can't point a direct line maybe to ROI sometimes, but it definitely shows up. Vertical integration. Here's some photos of just some of the team at our properties here. Again, kind of peppered throughout the presentation is some of our assets and some of our team members. But building the property management company is huge with a focus on world-class culture. Everyone involved wins is one of our core values that we started with from day one, and that was something that was taught to me when I literally did that first house project. It was this idea that we're going to take this house. Okay, the seller was happy. They won. We're going to give the contractor a job with some margin built in for him. He wins. The neighborhood wins because we're spending money cleaning this thing up. The bank's giving us a loan. They win. I was an investor in that project. We didn't have other investors, but I certainly won. And so it just kind of opened it up for me, whereas my experience previously had been in the corporate world where it's kind of like dog eat dog, and if we win, it's because somebody else loses. And that was kind of the mentality that I'd had for my corporate career, was a win-lose mentality. And what I found getting over to the entrepreneurial side is a lot of successful entrepreneurs have this win-win mentality. And that was a big shift. And so it's one of our core values for our company. Everybody involved wins. And so when we look at something new to do, we run it through the filter of our core values. If we're doing this, does everyone involved win? If it's a yes, then that's maybe something that we would pursue. But by doing that, everybody wants to go do it again, right? So that's been a lot of fun to go execute under that mentality. I had one of our oldest investors, or been with us the longest, he's like, man, you could have changed terms on me like years ago, right? You could have tightened things up or kept more. And he said, thanks for not doing that. And I'm like, well, everybody wins, and we're going to go do 100 more of these. And I want you on for the 100, not for me to make another nickel out of deal 3. So that's been a philosophy that we've had since day one. It's been really neat to see kind of unfold. Up here, I think you have random photos from some of our events. I think there's maybe like a boxing match or something, and some awards there, obviously a Christmas party, and different things going on like that. So we have a lot of events. We like to have a good time and get people off the properties and out of the office and go do events and stuff. That's part of our focus on culture. I think we got a video here. I don't know how in the world to play it, but let me push a few buttons and see. Yeah. I don't know. That was it, not it. That was not it. That's. There we go. Oh my gosh. It's like it took over. I don't know that how long this video is. I'll just kind of talk to you guys. So this is downtown San Antonio. This is $300 million San Pedro Creek Park project coming through. This is our office building. There's that beautiful waterfall you can see. And I just kind of wanted to highlight this for you guys. We moved our office into downtown San Antonio this year, bought it last year, moved in. And this is kind of our flag in the ground saying, hey, we're here in San Antonio. We're a San Antonio-based company. We bought this 150-year-old building, completely renovated it, and this is our corporate headquarters now. So this is where we office every day. We got the podcast studio there. Still on the windows. So they do these ghost tours. I haven't seen a ghost in our office, but it was literally around when we were fighting the Civil War. Isn't that crazy? That building was around.
It's been a win-win on that one.
Yeah, well, look, a win-win on that one is we're providing a lot of jobs, and we're bringing a lot of folks downtown. Oh, the hanging?
You're not hanging anymore.
All losing. All losing there. Maybe the community was safer. Supposedly they'd hang them and then throw them in the river, which is on the other side of our office. So you could come to San Antonio, go on the ghost tour. See.
Is there a bend by the river?
What's that, a bend?
A bend by the river.
There's a van down by the river. Go a little further south. Yep, there really is. There really is. Candy, the whole thing. So kind of coming wrapping up here, sustaining success What that's meant, and I'm so glad we started doing this, but diversifying into some new assets. So I always tell people starting out in real estate, figure out one thing and get good and have success, and then replicate it, and then replicate it, and then replicate it. And then if you do all those things, maybe branch out into something new. You know, I see people trying all kind of things, and they haven't had success with anything. I think you absolutely need success in something and repeat it before you go try new things. But we've had a lot of success in single family and multifamily. So we started diversifying into new assets. We started buying rural land, which I freaking love. And it's a completely different business model, but we just fold it into our existing systems, processes, and experience. Investors like it, we like it, everybody involved wins. Client and employee appreciation, so our employee events that we do, award ceremonies, birthday celebrations, all this kind of stuff is really important for the employees. And then for our clients, we actually do a gifting program. We send them stuff. I won't get into too much detail. You can invest with us and then see what you get in the mail, but we send nice gifts out there. And again, that's all back to kind of that goal of wanting to be a highly referable company. So that's a big part of sustaining our success. But then bottom line, getting into new assets. We're buying a multifamily deal. We're closing it next month. It'll be the first multifamily we've bought in a year. So we bought 600 units Q1 of last year. We're buying 114 units right now. And man, we went a year. So if we didn't have other things to do, that would have been a really tough year. Fortunately, we diversified in this land stuff. We diversified into light industrial. So we've got some photos here, top right, where you've got these contractor garages. And then diversifying into rural land that we could subdivide and force appreciation that way. And I think this came from me wanting to have more things to be able to do to put the team to work on, and more things to be able to put investor capital to work on. And the unifying item here is it's Central Texas stuff that we own and run and manage. So we're running the whole process. It's right outside of our door, or 15 minutes from the office, or a short helicopter ride away, or whatever the case is. It's all there, and we run all of it. Whether it's contractor garages, whether it's multifamily, whether it's land, whether it's mixed use, it's a DJE deal that we're managing, and that we are the largest investor on too. So getting into all those after years of success has been great. I kind of wouldn't recommend that starting out, doing a bunch of different things, but we have started small in all of these different channels and grown them, and it's been awesome because now we're not wholly at the mercy of the multifamily market or land market or whatever. All these things play a little bit different depending on what the economy's doing, but it gives us tons of options to deploy capital and put the teams on and do work. Some of the stuff here showing appreciation, client gifting I touched on, employee perks, community involvement. In 2020, I started a 501c3 nonprofit, so we take a portion of our profits from a number of our companies. It goes to the foundation, and then we get to write big checks, $10,000 and $20,000 checks as grants to programs that we have relationships with that most of the time are helping disadvantaged kids. So, I think we've got a check there. I don't remember what that one is. But one that a recent one comes to mind was to Aid the Silent, $15,000 to go down Del Rio and give a bunch of deaf kids hearing aids. Man, I can't talk about that much more. I'm going to get choked up, right? That is, to me, the coolest reason to be in business. So having that as part of the ecosystem, to me, you can't beat it. So showing appreciation to our investors, our employees, and then the community if we're winning, right? If we're winning, that means there's profit, and then that means the foundation is getting money. I know we have a bad quarter, depending on what was the gift to the foundation? Was it small or big? And I want big freaking contributions to the foundation because we run it at basically no cost and take all the foundation money and give it away every quarter. And honestly, there's nothing I like doing better than that. So keeping that kind of everybody involved wins going for employees, investors, and the community. I want to see where I'm in the presentation. Pretty much at the end. So we're going to wrap it up. I'd love to do Q&A if you guys have some. I mentioned and introduced Justin earlier. You can get on Justin's calendar if you want. We've got cards. We've got koozies over there, so be sure to pick up some of that stuff if you want to learn more about our firm. Quest Trust has been awesome to work with, and we have a ton of our investors are Quest Trust clients that have retirement money that they can't do their own deals with, and they put it with sponsors like us or other sponsors that work with Quest. So if you want to learn about that, get in touch with Justin. You got an opportunity to speak with him in person tonight. And I'll leave this slide up, and I would love to take some Q&A. Yes, ma'am.
So I noticed on your report here that you also do development.
Yes.
What new product have you built?
We've built single-family homes, townhomes, and the contractor garage product, which is 1,300 square foot metal box roll-up door that we rent to a blue-collar worker.
Would you consider multifamily, building brand new Class A?
Would we consider building new multifamily? Consider it, yeah, but the complexity is a lot higher than what we do. And when you look at the dollar per square foot of rent, to me, it's not there. Now, if we found a really killer deal on some land and it all worked, but there's a lot of development risk on any new development that's exacerbated on 200 units of multifamily. So, got friends that are in that business. Clearly, somebody's making money at it, but I'm always looking for the simplest, bottom line, the simplest way to get a yield for investors. And to me, that's too complex. Great question. Yep. Yes, ma'am.
So you talked a lot about culture and kind of enhancing that for your clients and for your employees. Are you also somehow extending that to the tenants and the tenant community, not just the rest of the people?
Yeah, so the question is, what are we doing for tenants, right, in terms of culture and stuff like that? Yeah, 100%. There's all kind of programs that we'll run, whether it's food or birthday events or Halloween parties or things like that we can do. Or a lot of times we'll bring in sponsors. Let's say a vendor that sells us a lot of flooring or does a lot of flooring. They'll come in and sponsor a resident appreciation event. So definitely. I think also though beyond that is being able to write the check, because multifamily I think sometimes gets a bad rap because you got owners that won't spend any money. Right? And then you've got a 1980s property that's in disrepair. We want to buy those, right? But these things cost millions of dollars to upkeep. So we're real well capitalized on the front end. I mean, if I'm living in an apartment, I don't care if there's a Halloween party in the office if my place is falling apart. The place falling apart costs a lot of money to fix. So I would say people want to hear about the party because it's fun and lightweight. The truth is we come in with millions of dollars day one to fix the place up, make it a safer community. And to me, that's kind of the real give back to the community is cleaning it up, making it pretty, making it safe for folks to live. So, great question. Yeah. Yes, sir.
Hey, Devin, I got a question about what do you mean by maxing out the cash accounts?
Let's see. Was that in the slide? Where do you see that? Or was that just a note?
In the middle of the slide.
I think probably we're just talking about reserves for the business, meaning you've got operating budget and making sure you've got a lot of extra cushion on there for bumps in the road. I think that's probably it.
No, you were on the slide that was talking about your options for defensive underwriting.
Gotcha. So options for defensive underwriting and maxing out cash accounts. Again, I think it's the same answer. I think it's just you think you're going to need this much to get you through this period or whatever the operating budget is and going, okay, now I remember when I said that word, maxing out the cash accounts, is pushing your reserves as high as you possibly can. Now, within reason, right? I mean, I would love to have $10 million of extra cash on every deal we did, just sitting there. But we're also paying out investors on that, so there's a balancing act there. But running those operating reserves as hot as we possibly can and maxing them out. I think that's what I was getting at there. Great question. Yes, ma'am.
How many apartments do you own? Not doors, actual apartment complexes.
I'd have to look at a spreadsheet. A dozen?
Okay.
Yeah. Doors, 2,200, something like that, and anywhere from 63 to 400 units.
And are your apartments, do you have like an insurance pool in order to keep the costs down?
Yeah, insurance has been tough. We've had a lot of headwinds with insurance. We do have a master policy, that we put those on. But Texas multifamily insurance been tough. But you know what? We always have headwinds, right? Always have headwinds. We have some tailwinds too, in terms of having irreplaceable product. You can't build 1980s multifamily infill anywhere near what we're buying it for. Population growth, all these other kind of tailwinds. Insurance, taxes, always a headwind, for sure. Yes, ma'am?
What are you doing now with the interest rate situations? Are you like doing floating and hoping for rate reduction, or are you doing fixed? What is your approach in the current market?
Yeah, so what is our approach in the current debt market? I think that's probably the most important question right now. I said earlier, debt drives all commercial real estate, so that's the most important thing. Two approaches. One, I have a goal, and maybe it's an impossible goal, to run this company without banks. I hate banks, but they're also our biggest partner. So on multifamily, it's fixed rate debt right now, absolutely, and it's low leverage. So we're doing a deal right now at 55% leverage, crazy low, fixed rate, great loan product, and that's awesome. Now, I had to look at a million deals to find one where that worked. So we're just not finding deals in multifamily that work. But yeah, right now the name of the game is fixed rate debt, for sure. Another thing we're doing, I mentioned not working with banks, is we'll do some of our deals all cash. So we might do a $3 million land deal, and I've got $400K in the deal. We raise the rest from investors. There's no banks. And that really, at that point, we're kind of insulated from what's going on with interest rates. Now we'll subdivide the land and sell it, and the buyers might be using a bank, and their rate's 300 basis points higher than it was a couple years ago. So there's some there, but as far as us, we're actually doing a lot of deals with where the capital stack is just me and investors, no banks. And that insulates us a little bit from what's going on in the debt markets. But again, debt drives everything in real estate. Multifamily, it's really difficult right now, and it's absolutely fixed rate.
So how do you make the numbers work basically with a 55% debt? Because that's got to be like a really big value add in order to actually make sense. One
is the basis, right? You're buying it at a price that makes sense, where you've got enough room to grow revenue. So how do you make a deal at 55% leverage work? Another was a rate at 5 that we locked at 5.24. So we're seeing debt quotes at 8.5%, on some of these loans, which we can't make that work. Having a loan at 5.24 helps. And then just the basis, if you're buying it, all the deals work at a certain number, right? So buying at the right price, getting your debt service rate low enough, and then having enough operational value add runway to make that work. I was actually surprised that one penciled. That's why we bought it. Yes, sir. Me too.
Do you primarily do you do Class C or like low income housing, or primarily like nicer?
I think that's two questions. Do you do Class C? Do you do low income? We definitely do Class C, which I think of as 1970s, right? Kind of vintage, at least what we've seen in San Antonio. We've done a ton of it, yeah. Do we do low income? We don't do any Section 8 stuff, if that's what you mean. Those I have, and maybe you have. You're clapping. Yeah.
I don't like them.
I'm with you.
Avoid them like the plague.
Avoid Section 8 like the plague. You heard it here, folks. Yeah, we don't like that because it's there's a lot there. But Class C, sure. Now, I think we're like a lot of sponsors. Over time, we've kind of gone to try to buy bigger, newer. I mean, I want the biggest, newest thing I can get. If I could buy 2015 construction and make it pencil, that's all I'd buy. Usually they don't pencil. But yeah, we don't shy away from 70s stuff. It's hard to operate, and we're good at that. It's kind of our thing. So yeah, absolutely we'll do it. But yeah, we won't buy an apartment complex full of Section 8. I've done that before, and it's brutal. It's brutal.
Does that include Laura?
I had a Laura on a deal once. Won't mess with that again. Yep. Great questions.
We have a saying, we don't want the government in our business telling us how to run our business.
I like it. Let's speak in my language. Yep. I say that too. And however, I'll take that Freddie SBL loan, please, government. So there's a little bit of that, but I totally agree that yeah, we don't want to mess with that. Give me as much free market as we can here. So.
Hey, Devin. Thanks for having us.
Thank you.
How do we find a management company to run these properties and then know which one to choose?
That's such a great question, a very difficult one. How do you find a management company and know which one to choose? Well, my answer to that was build it, because they're so bad. And now that I own one, I see how difficult it is, how thankless it is, how low margin it is, or no margin. Makes sense why there's a lot of bad management companies out there. So we built ours. Before I built mine, what I would do is, like any vendor, try to get a referral, right? And so that's what we do on property management companies before we built our own. And sometimes that worked out. I had a really good experience. I don't know how helpful this is to people. In some of my earlier deals, I partnered with a lady who owned a management company, but was also the broker on the deal. So she made more off her brokerage fee than a year of running the deal. But she knew at the exit she's getting that broker fee, and holy moly, did they work hard. So, but it wasn't sustainable because the broker fee was outrageous. It wasn't even market. It was above market. So I wouldn't recommend that kind of as a sustainable way to go. I think, if you're going to go third party, it's be real clear about some KPIs and manage those weekly. But also, putting my property management company owner cap on, if taxes go up 25% and your debt service doubles, this is a little me getting on the soapbox as a management company owner. Those are uncontrollable expenses for the management company. So management company, they can't do anything about your taxes. They probably can't do anything about your insurance. They sure as hell can't do anything when your debt service goes from 20 grand to 40 grand a month because you got a floating rate loan that you didn't budget for. So going back to your management company and saying, hey, our debt service went up 20 grand. I need you to find it in operations. That's just not happening. So you got your controllable expenses, your HR, payroll, repair and maintenance, marketing, and that's what you want to manage on a weekly basis. And also work with them up front during the due diligence to make sure that you're not just dealing with the business development person at the property management company. We got any business development people for management companies in here? My man. All right. So don't go to Sam to get your operating budget now. I'm just kidding. But I've seen a million pro formas that management companies put together to win business. And it's like the realtor that tells you, I can sell your house for $500,000. Okay, I'm going to give you the listing. Well, turns out they could sell it for $350,000, but they got your business, didn't they? So management companies operate much the same way. We've seen that a lot, where they give you a pro forma to win your business. So make sure you've got kind of a line of sight to somebody in that company that's actually got to deliver on that, whether it's a regional. Be realistic about what's controllable and not controllable. And be ready for whatever's going to happen on taxes, insurance, and your debt service if you have floating rate debt. That's on you as the owner. Yes, ma'am.
I also have something to add about third-party management.
Please.
For those that are considering a third-party management, you make sure in your contract that whatever program they're using, you own it. Because if you have to fire them, they're not going to be nice to provide you with that information. You make sure that your work goes with you so that they have an incentive to actually do their JOB. Otherwise, they're going to get paid whether the investors make a distribution or not.
Yeah, that's great. So if your management company's running Appfolio, that's your instance that you have access to. Because all the accounting's going there through. That is the brain of the business. It's all there, and you absolutely need your data, especially in a handoff or a hostile handoff. Great. It's a great point. Yep. Great point. Love it.
Hey.
Hey.
I have two kind of lines of questions
Sure.
for you. Sorry.
No, great.
I want to rewind in your life to pre-amazing firm. When you were just starting out as an investor, I assume you were an investor on your own. At what point did you feel like single homes needed to move into a firm sort of status?
Such a great question. Yes. You want me to address that one?
Yes, please.
Yeah. So question is, starting out investing, when did it become necessary to have a company around it? So my first house, 311 Hammond in San Antonio, was a $40,000 purchase, $10K of reno, so $50,000 kind of all in. Got a hard money loan, and I think I was cash out of pocket like $8,000. So I had $8,000 myself, and I was terrified to do that deal, and certainly not raising money or anything like that. So I did that deal. It worked. I had a coach. It went like they said, more or less. He called it a textbook deal. I thought, okay, well, if that's it, then I can do that again. And so my goal starting out, I didn't really start out with much capital, so I wanted to do houses where I didn't have more than $10,000 in it. I was mostly using the hard money company. And so I did the first house, and then I waited a couple of months, and then I did the next house, and then I started doing about a house a month. So I did about 10 houses in a year. Because some of these houses I would buy, and by the time the hard money lender was, and they're poking my eyes out on fees and everything, right? It was 13, 14% interest, 3 points, bunch of fees. I mean, whatever the legal limit is for usury, I'm sure they were right at it. But there you go. There you go. We got a smart room here. So, but it was OPM. It was other people's money, meaning that I might have $5,000 of my own money in that house. So once I'd done a few of these, I thought, I'm getting out of corporate. I'm building equity. Each one of these houses I got equity in. I could see the future where, oh my gosh, I'm going to do big things. And so at that point I decided I'm going to burn the candle at both ends, work my job, and build the investments until my trigger was cash flow from these rentals that covered my bills. And that wasn't going to be like set for life, but I would have my bills every month with my young family, and my wife who was able to stay home from work, cover all those bills. So that took me about 2.5 years of doing houses and rentals and a small apartment complex, 6 units. And then, I was able to bet fully on myself, leave the job with the idea that if I had all my time and energy to put into this company, that we could really grow it. And that's what happened. So once I had all my time and energy back, I actually negotiated with my boss I said, hey, I think I can do this as a consultant for you, and you guys can pay me less. I was working for a big medical device company that everybody knows. I think you can pay me less, get me out of the office, take me off the benefits, and I knew in my mind I could do the job in 5 hours a week. So I thought I would double dip. I'm going to consult and do my real estate business. And he ran it up the chain. I actually got it approved. I felt bad, super nice guy. And then when it really came down to it, and he said, yep, you can do the consulting thing. I said, you know what? In my mind, I'm going to bet fully on myself. I don't want anything to do with this job. I'm going to go all in on the business. And that's when it became a company, started hiring people. And also the whole plan was to get these bigger assets, right? I think a lot of people want a house, and then maybe they want 10, because 10 rental houses, man, you can kind of pay your bills and kind of like live and not work, and that's the dream, to have that passive cash flow. But at some point, it just didn't scale. I wanted 1,000 units, right? I knew some guys that were further down the road, and I wanted that, and that needed a team and a company. And so that was the inflection point for me starting a company, growing the team, was getting into multifamily, really.
So it took you about 2.5 years to go from normal investing as a single person to multifamily investing as a company.
Yes.
Cool. Follow-up question.
Sure.
Who were your specialists that were necessary at the beginning? What type of specialists did you need?
Awesome question. Yep. So I think the first hire for any entrepreneur is just somebody other than you. And for me, that was a virtual assistant in the Philippines. Just somebody to like take these tasks, complexity 1 through 10. I need to focus on the 6, 7, 8, 9, 10s. I need somebody to just like do this thing. And so that was number one, was a virtual assistant. Number two, growing out of that was an actual office manager. Same kind of thing, handle all this stuff, but somebody here in town that I could talk to and cost more but can do more. And then after that was, after we kind of grown, was investor relations. So Justin's run that whole department for years now for the company because you start realizing, man, we need to have these investor conversations. We need to have a great experience. I have a bad experience as an investor when the investor relations is the founder of the company. Because he's got 100 million other things to do than to take my call as an investor about, oh, this K1 thing or whatever. So splitting that off was important. And then you start getting into the property management side. So majority of our employees are in the property management company. If we didn't have the management company, we'd probably be a 10-person firm, less. Kind of wild because, you know, the management company just takes so many people to run and do it right. But yeah, so to answer your question about specialists, somebody to get you as the entrepreneur out of doing the level 1 through 5 tasks. And I literally make a spreadsheet, write down all the things that I did in a week, and then rank them 1 to 10 complexity and rank them 1 to 10 value. Like if I'm playing golf with an investor that's going to invest $1 million with us, that's a 10 value. Even though it feels like fun and it doesn't feel like work, that's 10 value. There's lots of other tasks that fall lower in that. So I would look at the high value, high complexity tasks, and how do I just get ruthless about focusing my whole day around that and finding other people to plug in. But pretty early on, it was investor relations, and there's that's a big jump though, right? I think you have to have some assets and some things in place to be able to support that. And then beyond that, now it's gone to accounting team. It's gone to the property management side, which we also kind of use for a lot of our asset management, which is definitely killing 2 birds with 1 stone. Handling all our draws. I mean, I'd say the accounting is a huge function of it because the accounting stuff will really bog you down. You know, if you've got $500,000 of capital improvements to do, well, you've got to front it, finish it, pay the contractor, sign lien waivers, and then start banging on the bank's door to get your own money back. And that is a process that takes a lot of work, and we're thankfully have a team that can focus on just that. But I've done them all. I've worn all the hats. And I think it's just been getting to a pain point where I'm going, man, I'm really not focusing my day on what's going to move the company forward. I got to bring somebody in for this piece and this piece and this piece. And building any business is, 3 steps forward, 2 steps back, 3 steps, and that's just any business. This is no different.
Awesome, thank you. My second question.
Oh, wait,
Sorry, guys.
that was your 2. No,
I
I'm
will.
just kidding.
I'll give it back here. This one's probably going to be easier to answer.
Sure.
So I loved what you were saying about culture, and you said culture probably 50 times, but we got 1 core value. I'm just curious if that's the only core value you have as a culture. Everyone involved wins, and then is there any others? Or?
Yeah, awesome. So the core values, and I don't know what's being recorded, what's not. So I'll repeat the question. The question is, talked about culture and core values. What are the other core values? So the core values, I actually spent a lot of time on these when it was just me. And I thought someday this might matter. And I'd seen it matter at a company called Rackspace that had thousands of employees. And I would see people like rally around the core values. And I was just like, and I remember our CEO saying, he came from Wall Street and he's like, these core values are stupid and he took them down, and there was like a line of employees at his door, like, what? This like matters to us. So I kind of seen that. So our core values are everyone involved wins. I kind of elaborated on that a little bit. Another core value of ours, which I actually borrowed from another company, I saw the CEO speak at a conference, but I really liked it, was delivery at all costs. And I've seen sponsors freaking fall down left and right. Actually, we just took over a deal that I'm a partner on because the sponsors running the deal were not focused on delivery at all costs. I don't care what's going on in your life, with your finances, with whatever. I gave you money, deliver at all costs. And there's just been 1,000 times in my investing career where it sure would have been easier to call the lender or the investor and say, man, we ran into a tough spot. We saw unforeseen issues. And when I get that call from a sponsor, I'm like, I don't want to do deals with you. You know, this is a hot button for me, but
Well, commitments matter.
the commitments matter. And, you know, there was a deal that that we took over, and the partner was kind of trying to negotiate that he would stay in the deal. And I said, this thing needs a check. If you want this deal, sell your house, sell your car, and buy the deal. Because that's what I would do, and that's the kind of stuff I've done building this company. And if you're not doing that, you shouldn't be doing this. So Deliver at All Costs started with the first guy that gave me $100,000 to flip a house. I couldn't believe it. Now, he had a first lien and all this stuff, but it was such a, what you're dealing with is it's not money. It's condensed life energy. If somebody gives me $100,000, they spent a lot of their life that they'll never get back and gave it to me. Whew, man, that is a massive responsibility. So Deliver at All Costs is our core value. So that one means a lot to me. They all mean a lot to me. Another one is Tiny Improvements Daily. And this is one that I spent a lot of time on. Read a book about the guys that trekked across Antarctica or whatever, but they'd have these markers and they couldn't see, but they got to get to the marker. And if they get 1 degree off course out in Antarctica, they're dead, right? And by the same token, if we can get 1 degree better, James Clear writes about this really well, and a million other people, but this concept is your trajectory, if you get 1 degree a day or per hour, whatever, you're going to end up in a completely different place, right? I'm a pilot. I flew here from San Antonio in my helicopter today, and if you're watching your track, if you get distracted and you get 1 degree off, 10 minutes later, you're not in Austin. You're in a different spot, right? So we want to purposefully change our trajectory. What is 1 degree different we could do today? What is a tiny improvement we could make that's going to, 5 years from now, put us in a completely different place? So Tiny Improvements Daily is another core value. So we've got everyone involved wins, Deliver at all costs, Tiny Improvements Daily, and the last core value for DJE, put me on the spot, I don't remember it. I'd have to look it up.
Be proud. Do work you're proud of.
Do work you're proud of. I feel like that's kind of the dog of the core values, to be honest. I think we could have 3 core values. But do work you're proud of. Look, this is important to me when we got into real estate. This is like stuff that was built decades ago and stuff that's going to be around for decades. We're kind of a steward of it for a little bit of time. So being proud of that, and I think it could maybe be don't be a slumlord, like spend the money. I mean, we got to run projects on budget, but we make nice stuff. We make we make the apartments nice.
Best product, best price.
I like that one. Yeah. So being proud of the work we do. So those are our core values, and I appreciate you asking about that.
Okay, I'm curious, where did you park?
Where did I park?
Where did you park?
Yeah, to Austin Executive. They've got a couple of helipads out there.
All right, we got about 2 more questions, and we have 1 online.
All right.
Hey, Devin, Rob, I would say Atomic Habits by James Clear. It's a great book.
Yes.
I love it a lot. This is kind of a tangent from your traditional investments, but I'm kind of curious what your thoughts are on office space, office buildings specifically.
You know, it's funny. We have an office building, or we have a building right now that's mixed use and has some office. All I keep hearing, so first of all, trying to listen to people that haven't done what you're asking them about. So I'm not the office guy, right? Ask me about multifamily, ask me about rural land, ask me about whatever. Raising capital, property management, not an office guy. That saying, we got a building that's got some office component, and every broker I talk to is like, oof, office brutal right now. So we might cut that up and do like co-working stuff. In fact, I was talking about that earlier tonight. I would not, I would not want to be holding a lot of office. I had a guy on my podcast today, though, it was interesting. You know, this whole idea of greedy when others are fearful, buy when there's blood in the streets. There's blood in the streets on office, for sure. If you got the stomach for it, maybe it's an opportunity. I don't see it. I really don't want to deal with it. It doesn't check the boxes for us. We do have some office or space that's kind of currently office that we might do co-working just to get some leases on. But honestly, I don't know. We would also entertain office to multifamily conversions, I think, in the right case. But as far as like just leasing office, from what I've seen, that's an uphill battle. But I'm also not your expert on it. Good question.
Or converting to mixed use.
Right. Yeah. And we've done some of that. Yeah.
So can you expand a little more on your raw land deals on an investor perspective? How long do you hold the land? What kind of, do you pay distributions or do you wait and pay in lump sums as you sell the land?
Great question. All land deals are pretty much the same. It's 12-month maturity, pays 11%. Distributions monthly. We escrow the distributions like a construction loan or like a hard money loan. So we raise all the money up front, pay the distributions, and then exit within 12 months. And we do it as debt. So instead of being, the apartments we do as equity. So we come in with a bank loan and equity comes on top. Higher payout, maybe it's 15 or 20 IRR, and some distributions along the way, pretty solid, but higher risk profile. You're higher up in the capital stack. Our land deals, I talked about not dealing with banks. $3 million land deal, we'll go put it under contract cash. And that enables us to get a better base on the land. Then I come in with 20% of that capital. We bring investors along for the rest as debt, pay it out 11%, and it's in and out in a year.
Do you have to be accredited or non-accredited as well?
We can do sophisticated, non-accredited
Ooh, I got
on those.
them for you. Okay.
Great. Yes, sir.
You're doing them as debt, so is it a subordinate lien or is it first lien for the investor?
First lien. Yep. There's only one capital class on the deal, which, I mean, it's an 11% return versus 15 or 20 on multi, but it's a completely different risk profile on it. Great question.
So for the question online, probably fits right in here. 5 words. Minimum investment in a project?
$50,000.
There you go to the person online.
Thank you. Great question.
Okay, do we have any more questions?
What about your debt funds? What's that about?
Debt funds.
Yep. So we found kind of 10% annual interest to be this pretty attractive point where we've done all kinds of deals over the years with investors in a debt product. So we just launched a fund because there's enough and I've resisted this for years because felt like we didn't have enough places to put it, and I don't want to be sitting on 10% clock and know where to put it. But now we've got enough stuff going on between small deals, land deals, small construction projects, things like that, to say, hey, let's launch a fund. We can load it up, and I've got places to put it at low leverage, first lien positions that can pay out 10%. And so the fund we launched this year, it pays 10%, pays monthly distribution. So $100,000 investment gets monthly distributions on the 15th at whatever it is, $833.33 a month. We lock it up for a year, so can't touch it for a year because we need to go deploy it. After a year, you can recall it. We need 90 days to recall it. And that one is only accredited. It's a 506C. Yep. Which was strategic on our part. We want to be able to, talk about it and market it and stuff like that. But it unfortunately is only for accredited. Yep. Did that answer your question, sir?
Yes.
Okay. Yep.
All righty. Well, we're going to go ahead and wrap it up. If you guys do have more questions, you can feel free to ask them during the networking. But let's give Devin a big round of applause.
Awesome. Thank you very much. Appreciate it. Thank you. Wonderful. Thank you, sir.
We got this guy working now, so you can keep that one.
Yeah.
Alrighty. So now is the time during the night. If you guys have a deal, if you have a service, you can come and take this mic from me. We are about 15 minutes towards the end of the event, so we do ask that you keep it to about 45 seconds to a minute. But feel free, come up here, take the mic from me, and have the stage.
Hello, everyone. For the people that are here in person, I actually have little printed cards that you can take. I actually just wanted to offer something free for everyone. I created a calculator that you can access online that tries to simulate what it is like to invest in a syndication. So if you're not convinced yet on the advantages of investing in them, you can go and play with it yourself, amount, how many years you want to simulate. But it's online at wealthcindy.com/calculator. So that's wealth, like wealth, Cindy, like the first part of syndication.com/calculator. So play with it. If you have feedback, there is a link on the bottom. Tell me what you think. Yes, I do. I have like little.
I think I actually scanned the QR code earlier, and it was really cool. You should check it out, yeah. Anybody else? All right.
Hello, everybody. My name's Sam. I'm working with Appreciate. We're a tech-enabled property management company based out of Missouri. And why I'm in Austin is because we're working with out-of-state investors that are looking to invest in multifamily in higher cap rate environments. I don't know if you guys follow Bigger Pockets, but they've been talking a lot about Kansas City, Missouri. Columbia, Missouri is where I'm from. It's a college town, but there's a lot of the reason I was asking our speaker about low-income housing is because that's specifically the type of stuff that we're working with. We have a really good operations team that can just work with the value-add property. So if you are into multifamily and you want to get into the Midwest, that's where we're at. I don't have any business cards, but happy to talk more. 573-721-7344. My name's Sam Dudenhafer. I'm on LinkedIn as well. 573-721-7344. I kind of mumble a lot. Thanks for the plug.
Yep, for everyone online, we want to make sure that you guys get all the information as well. We do have quite a few of you guys, so if you guys want to take the mic, one or two more. Awesome. All right. I love the outfits, by the way. Thank you so much.
Hey guys, my name is Emily Snyder, and we do commercial real estate, and I primarily focus on syndication properties, so finding off-market, on-market properties for clients that I work with, whether they're 10 units, 50 units, 100 units. Actually, Devin's 600 portfolio, I sold it to him last year. So I'm comfortable in any price range, coaching you through questions that you have in the transaction process and so forth.
We not only work in the San Antonio market, but we're also in the Houston market, Dallas market, so larger capital markets as well. We not only do commercial multifamily, we also do industrial warehouse spaces like the one that he had up in the screen earlier, and commercial land. Okay? Accelerated commercial real estate. My name is Tessa Martinez. You can find me on LinkedIn and
then Emily Snyder on LinkedIn, and then it's acceleratedcre.com in case you guys want to find us online. Thank you.
All righty. Anybody else? Okay, we've got a little bit of networking already going on in the back, so I'm going to go ahead and wrap it up. But thank you, everyone, for joining us, and thank you, everyone online. If you have questions, come talk to me in the back, and we'll see you next month.